Hello and welcome to The Trade. It's Wednesday and we're coming at you from our studios here in Barangaroo. I'm Cara Ordway. Well, today the topic on The Trade is Japanese candlesticks, and as our guest on the show says, not the type that you buy at Temple & Webster, rather the 300-year-old trading technique developed in Japan in the 18th century. To tell us how a picture paints 1,000 words, Carl Capolingua joins me now live via Skype to go through it all. Carl, thanks so much for joining me today from ThinkMarkets on The Trade. Look, we all look at charts every day as traders. That's the thing that we have up on our screen. You know, we see the red, we see the green, but there's much more in the detail, isn't there? So I know you brought some visuals with you to go through it. Let's start with the basics if we can.
Yeah, sure. Good afternoon, Cara. Thanks for having me on. And look, I've been looking at charts since the 90s, since the early 90s. The first book I bought on technical analysis was a small little red book by Regina Miani. Maybe viewers can go check that one out. And it was some time, studying technical analysis before I found Japanese candlesticks. And I think I was flying somewhere and I bought a book just on the way to the airport, and I was going to read it on the plane. And I tell you what, it really, really changed the way I looked at technical analysis and the way I looked at the markets. It was almost like night and day for me before I found Japanese candlesticks and after I found Japanese candlesticks. So why are they so important to me, at least? Well, as you say, picture tells 1,000 words, but I think it's really special with Japanese candlesticks, the way they're created that helps us tell that story of the markets. And really we're telling the story of supply and demand, of fear and exuberance in the market, and where the supply and demand is on any particular period. And if we look at over a range of periods on these Japanese candlesticks, where that supply and demand might be in terms of the bigger picture and how it's changing over time. So the first slide I've got for you is one where we can sort of do a bit of candlesticks 101, I call it. And Japanese candlestick is different from your bar chart in many ways, because we're going to put some color on the chart. And I think that's really important as well, because as humans, we're very visual. And when we can see the colors, you can make them any color you like. I prefer the old-fashioned black and white, but you get hit very quickly with the message on the chart. So very simply, the open, or I should say, if the close is below the open, that's the first candle we've got on the left-hand side, we will fill the candle, it's the box part of the candle, which is called the body, we'll fill that in black. And if the close is above the open, that's the second candle there from the left, we are going to leave it white. So that's the difference between the open and close. And sticking outside of the open and the close, we have these things we call shadows. And for example, it could be the difference between the open and the high, or the close and the low, and vice versa. But effectively, it's where the market didn't stay for that particular trading day. So it might have opened, gone down, there's a little shadow, and then gone back up to the close, or gone higher before it closed a little lower. So the black candles, as you would expect, being a down day, represents supply in the market, and the up candles, the white candles, represent demand in the market. We can then start to take cues from these. As we look at a chart, we see lots of white candles, there must be lots of demand. If we see a chart with lots of black candles, there must be lots of supply.
Yeah, and of course, Carl, that can be over any period of time, right? You can look at a 1-minute chart, you can look at a daily chart, we can look at monthly charts.
Yeah, look, absolutely. And that's the beauty of Japanese candlesticks. They're not limited to any time frame. So if you're a shorter term trader and you're trading those intraday time frames, you might be trading foreign exchange or commodities or crypto, very popular at the moment. Absolutely, you can use Japanese candlesticks. Or if you're a longer term self-managed super fund trustee and you're managing your retirement savings, you can use potentially a weekly or even a monthly chart and use your Japanese candlesticks there. So you're not limited by time, you're not limited by what you're trading either. So there's a couple of fancy names with Japanese candlesticks, as the name suggests, created back in Japan, funnily enough, in the 1700s, used initially to trade rice futures. It's amazing how they've survived that test of time, and people are still using them today. And I think it's because, as we said, picture tells 1,000 words, and there's a couple of other patterns there I can talk to you about if you like.
Yeah, let's bring it back to a case study if we can. I know Afterpay is always one that we look at because it's always good for these case studies. How would you apply this when looking at a trend on the charts?
Yeah, look, I mean, Afterpay's always the classic, and I do like to use that one. We can see on screen, and now I've gone for the Afterpay top. So this is kind of the anatomy of how that top played out. It was topped out at about 160.05 cents, and then we saw it fall below $100 just a couple of weeks later. Now, if you knew your Japanese candlesticks, you could have seen this. It's like black and white on the chart, pardon the pun, but it's that clear. So we might just go to candle 1. Where we can see that demand coming in. We've had a few black candles where we've seen some supply come in. The white candle tells us the demand is there on candle 1. Candle 2 really confirms it. It's that Maribozu candle. Maribozu means shaven head in Japanese, funnily enough. It means it's got very, very small shadows on it. It's a pure demand or supply kind of day, and this is a pure demand day. Tells us the money's coming back in, and up we go. There's a little black one after that, halts the trend for a little while, but we pick up on candle 3, and then the key interesting candles come in at sort of 4, because you see that giant spike in volume there, and this is how we can use traditional technical analysis with our Japanese candlesticks. So that's telling us we got off to a very strong open. We can see it gapped up on the open quite a bit. And probably might have been some news, I can't remember exactly the day, but lots of demand coming into the system. Now, if you're a big fund manager who wants to get out, the best time for you to sell is when everybody's buying. And that black candle tells you that somebody big came in and knocked this market down. Candle 5 did pop back up, but on very, very little volume. Then candle 6 is again showing the sellers are still in the system. We're not clear of this. Candle 7 is probably the key for me, because it really tells us that we tried to go up in the morning, and then we got belted back down by the end of the day. That's one of those hammer candles, and then it was down from there. Often we see once we make that top, you get a confirmation of that high, and if candle 7 is probably the most important on the chart, candle 10 is easily the second most important, because we reached back into those highs and then we're beaten back down again. And that shadow, we often say that the shadows on the candles are pointing to where there's demand and supply. A shadow pointing up is pointing to supply on the chart, and there was clearly lots of supply, and the market just fell away from there.
All right, so if you're looking at that then, that point 10 in terms of the candlestick that you pointed out, that hammer, if you were trying to draw the technicals on, look at the support and resistance, where would you go from here?
Yeah, look, I mean, that's exactly where we need to go from here, more than just where to go. That's where you have to go. So we're using the Japanese candlesticks to tell that story over sort of a candle-to-candle basis, but then we're incorporating our broader support and resistance themes, which I talked about the last time I was on, funnily enough, on to work out when the trends are changing. So you look at that candle 10, and it reached up. On that day, investors, or at least the open was very positive, and we were beaten back down by the supply that was probably there on candle 4. And we noticed that the high of 10 is lower than the high of 6, so we're getting those lower peaks coming in, and then we break through the low of 8. We are now officially lower peaks, lower troughs in that new downtrend phase. That sets the high of 6 as a major high, a major resistance point, 160.05 to be exact. And given the size and the significance of candle 12, you could say with great confidence, and I mean 90% confidence that 160.05 was not going to be touched for a very, very long time. And in fact, the most likely path of resistance was down from there.
All right, given all of that then, as you said, it's really how the market closes on the day. It's not how it opens. So you are looking for that end of day print. Given that, what are your forecasts when it comes to that stock, when it comes to the technicals?
Yeah, look, you make a really, really important point. So this is kind of one of the early mistakes I made with Japanese candlesticks. You get excited, you read the book, you go out there and you start trading, and you see this fantastic white Maribozu candle, and you go, wow, look at all the demand, and you jump in on the buy side, only to find that by the end of the day, it's turned into one of those horrible hammer candles, and you're in at the top. And that's because you have to wait for the close of the candle before you can take the message that's coming with that candle. The fund managers are out there, like I said, that's often the best time to sell is when people are buying, and they will hit those, often those big white candles into the close. And it's the close that tells you what actually happened on the day. So you have to wait for the close. It's so important. And that means you're often trading at the open of the next trading session. That's, I guess, the practical upshot of it. So if we're looking at Afterpay now, exactly what's happening now, and we have the final candle, today's candle on the chart, you can't take anything out of it until we hit 4 o'clock Sydney time. What we're seeing at this point in time is that there is a bit of a bounce going on. We've got candle 6 is that nice hammer candle. It is a very strong downtrend though, and unless we see a big white candle come in to tell us that selling has stopped, and in fact we've switched to a demand side market, I think you need to be very, very cautious. I think you need to be even more cautious if we start to see these shadows pointing up come in on candle 7 or tomorrow or the next day, was that would tell us that the supply has not finished with this one yet, and we could be seeing lower prices. But, we need it's a puzzle. We get it piece by piece, and we'll see how we go over the next few days.
Carl, I'm going to put you on the spot just before you go. When you're, working through the technicals and you're looking at stocks compared to overall equity markets, is there a difference in you play out those technicals and what you're looking for?
Not really, no, because you can use these Japanese candlesticks on any instrument you'd like. The problem between trading, say, an equity and, for example, a foreign exchange pair is often comes down to the volume. So it's more about when we try to marry these candlesticks up with some of our other technical factors, and you don't often get volume for example, the Australian dollar. It's very hard to get volume data on. We do have volume for the ASX 200, so that's fantastic. We can use this analysis with our candlesticks overlaid with our volume and volatility analysis in that respect. But basically anything you can get volume on, you can use as a more holistic, broader approach. But Japanese candlesticks, look, they're just one piece of the puzzle. I encourage everybody to get out there and learn more about them and just build that arsenal that you have when it comes to your technical analysis tools.
Yeah, I guess you're looking at those illiquid stocks. It is very much harder to read the charts. But thanks so much for joining me on the trade this afternoon, Carl. As always, very educational. We loved it, and hopefully we'll develop that further and speak to you soon.
Great. Thanks, Cara. All the best.
Well, that does it for this edition of The Trade. Be sure to tune in tomorrow. We'll be back with all the action. Thanks for watching.